Hey, Ready Marty Mazur. Good evening, 23rd of February 2016. Just wanted to update you on the chart. You may recall yesterday we looked at this pattern here where we shot straight up against this 50% retracement level and couldn't hold it, tried and tried, and I told you that closing below it was not a great technical sign. Plus, I suggested that the market looked very overbought to me on a short-term basis, and to look for it to trade lower. Well, it did right away. Dow was down about 190 points today. Didn't quite fill this particular gap, but got very, very close. Futures are down a little bit now as I speak, so we'll see how tomorrow looks. Today wasn't just the technicals, though. The oil had a rough time. The OPEC minister had suggested today that there's no way there's going to be any production cuts on the horizon. And I think even from his tone, maybe even called into question this agreement on freezing production where it is. He didn't in so many words, but he inspired no confidence that it makes any sense for OPEC to slash production at this point. So of course that was bearish for oil prices today. Add to that from the banking sector, J.P. Morgan CEO Jamie Dimon had suggested that the hit to the bank's portfolio in terms of potentially bad energy industry loans was bigger than might have been previously thought. And if oil does get down, to the 25 range again, they're going to just have to basically compensate or account for the potential for greater losses. JP Morgan is not in any kind of trouble whatsoever. This has the hit to the banking sector from the energy space is just absolutely pales in comparison to the events of 2008. But as I've said several times over the last couple of months, anything that even whiffs of credit risk, given what we went through in 2008, kind of sends the market into a tizzy. Banks look very cheap to me. We actually came into the year with a great deal of optimism over banks because of the potential for the Fed to raise interest rates and what that does positively for bank net interest margins. Now that we're beginning to see some signs of inflation, and I do think inflation is going to become a bigger issue for markets as the year unfolds. You can see it brewing. Then, of course, the talk of more Fed hikes will be back on the table quite firmly. You would see banks, I think, potentially, at least on a relative basis, do well against other sectors in that environment, particularly if the economy holds up. And as I suggested over the weekend, the recent indicators are suggesting that the economy is doing quite a bit better than some people would have us believe. So folks, it's going to be interesting going forward. So today was, I think, somewhat, to some degree, the technicals, I think for sure, as I pointed out to you here. But I also think it was very much about the price of oil coming back and JP Morgan's comments and therefore a sell-off in banks and so on. So very volatile environment we live in today. I think it remains volatile. I think it's going to be quite the interesting year. I think valuations are fine, particularly after the recent sell-off. And I think the stuff that we own, in fact, I know the stuff that we own in client portfolios is very high quality stuff that I think you can sleep like babies at night with, as long as you don't let the traders pushing and pulling on stock prices in the short run bother you. So, folks, I'll just leave it there for today. And of course, I'll be back very soon with more. Have a great one. Take care.